Hey guys, what's going on? My name is Justin. Welcome to my channel. If you guys are new here, go ahead and hit that subscribe button. Even though you don't really know anything about me yet or about my channel, just go ahead and hit it because you're not gonna regret that decision. Today we're gonna look at my investment portfolio. I have an M1 Finance Roth IRA and personal investment account, but right now we're looking at my aggressive growth portfolio. And this portfolio is around $24,800. It just keeps going up and up and up. Every Monday I put in money into this account. I put in $385 this week. And I wanted to make this video because if you look at my pending buys, you can see if we click here on view details on upcoming trades, that I am buying only Shopify stock. And I want to talk today about diversification because there's a really good Warren Buffett quote that talks about concentration versus diversification. Yeah, I tried to say that 10 times fast. But really what Warren Buffett here and Charlie Munger and a lot of other people are talking about, and I'll show you the quote here in a second, but when they talk about diversification, diversification is really good for people that don't know what they're doing, don't want to put time into learning about stocks or doing research. They never want to look at their stocks and they don't care about their stocks. They just want to be invested in the stock market. Or it's for people who maybe have a lot of money and they're trying to preserve that money. So the Warren Buffett quote is that concentration builds wealth, whereas diversification preserves it. And so the idea here is that if you guys are trading with a small portfolio, you don't have a lot of money, then concentration is a really good strategy. And it's a strategy that I use a lot here in this portfolio because, again, it's only around $25,000. And I'm trying to grow this portfolio to be $500,000 to $1 million in the next 5 to 10 years. And that's not going to happen if I buy all these stocks. I really need to concentrate on the stocks that I feel like have the highest chance of going up, and I need to put as much money as I can into those stocks. So let's go ahead and look at the quote from Warren Buffett and get his take on it. If you can identify 6 wonderful businesses, that is all of the diversification you need, and you will make a lot of money. And I can guarantee that going into a 7th one, instead of putting more money into your first one, has got to be a terrible mistake. Very few people have gotten rich on their 7th best idea, but a lot of people have gotten rich with their best idea. So I would say for anyone working with normal capital who really knows the businesses they have gone into, 6 is plenty, and I probably have half of what I like best. I don't diversify personally. So this is Warren Buffett, who owns Berkshire Hathaway, saying he doesn't diversify. And when he was first getting started, he was very concentrated in his positions. That's just how he invested, and that's how he was able to build his wealth. And now that he's grown to multi-billions of dollars, he diversifies a little bit more than when he first started. But I like what he said there. He said that, if you can find 6 very good opportunities, 6 very good stocks, why would you put money into your 7th best idea? You're going to want to put money into your best idea or your best, top 5 ideas or 3 ideas. And that's really what I'm trying to do with this high growth portfolio. I'm trying to put as much money as I can into the stocks that I think are going to be the most lucrative for me, the stocks that are going to go up the most. So right now, that's why I have 50% of my entire portfolio into Shopify. This one's from Charlie Munger, and it says patience, which is in another one of Warren Buffett's quotes as a very important quality to have as an investor. But patience followed by pretty aggressive conduct is given to human beings who work hard at it, who look and shift the world for a mispriced bet that they can occasionally find one, and the wise ones bet heavily when the world offers them that opportunity. They bet big when they have the odds, and the rest of the time they don't. It's just that simple. So what he's saying here is that you're not going to find that many good investment opportunities where maybe the price is off or you find a really undervalued stock. And when you do find that opportunity, you want to put as much money as you can into that opportunity. Here's another: I can't be involved in 50 or 75 things. That's a Noah's Ark way of investing. You end up with a zoo that way. I like to put meaningful amounts of money in a few things. So that's good. Here, let's look at another one. Charlie Munger considers that a portfolio of 4 stocks is a well-diversified portfolio. He says you don't even need a 5th stock. He goes on to say that if you lived in a small town and if you owned the best apartment building in town, if you owned the highest quality office building in town, if you owned the McDonald's franchise in town, if you own the Ford dealership, if you own this collection of assets, even though they're all geographically concentrated, his perspective is that you will do very well. You will not need to do much else beyond that to have an interesting investing career. So yeah, so again, all of these guys, these very, very successful, famous investors, they all are saying the same thing, that when you're first getting started and when if you're really wanting to build wealth, if you out there do not have a lot of money, if you're trading with a small portfolio, don't go buy, tons and tons of stocks. Do your research and put your money into the stocks that you think are going to go up the most, that you feel the best about, that have the best investment thesis, the best investment outlook. Okay, so really what this principle boils down to is opportunity cost. And what opportunity cost is the loss of potential gain from other alternatives when one alternative is chosen. So for example, holding cash instead of investing in a high interest savings account. So if you're holding cash and you're not putting your money in a high interest savings account, then you're automatically missing out on whatever interest rates are right now, 2%, 1.8, 2.2, whatever they are. Holding in cash is risky because you're missing out on the opportunity of making a guaranteed return on your money. And the same thing goes for buying stocks. When you buy one stock over another stock, there is an opportunity cost in that the investment you have chosen might not go up as much as the investment you could have chosen. And so that's really what we're talking about here with concentration. We want to put all of our money or a majority of our money into the investments that we think will guarantee the highest return or have the highest potential for the highest return. Here's something else that I want to talk about really quick, and that is ETF investing. So let's go ahead and look at ITOT, which is the total stock market. It has over 3,500 stocks. It is basically as diversified as you can possibly get when it comes to investing in the US stock market at least. And let's go ahead and see what happened to it in 2008, 2009. You can see here in 2007, end of 2007, we had a peak. So let's go ahead and pick here and let's see. Okay, so it dropped over 50%, around 51%. Yes, 51%. But since that bottom in 2009, it has gone up 361%. So go ahead and remember those two numbers, -50 plus 360. Now let's look at Amazon, which at the time only had a market capitalization of 33 billion. So it was a very small company compared to the US stock market. Now it has over a valuation of $1 trillion. So it's gone up tremendously since 2008, 2009. But let's go back and let's look. So it looks like we have a high about here. Well, we can go back to September. Let's go back to here. And let's go all the way down to here. Okay, so it's down 59%, a little more than ITOT, which was down 51%. But let's see what it's done since that low. It's gone up 5,537%. So if you would have taken your money, $100, and invested it at the top of the market in ITOT, today you would be up 361%. But if you put all your money into Amazon, you would be up 5,537%. So the opportunity cost of you investing in the total stock market ETF as opposed to Amazon was huge. I mean, that's thousands and thousands of dollars, assuming that you invested like $1,000 at the top of the market in 2008. Now, Amazon was a small company, but let's go ahead and look at Apple. Let's see, because Apple was a slightly larger company at the time. So let's see what they did. They dropped about 50%. We got 48, okay. So about 50% drop. But let's see what they've done since the low. 2,236%. So guys, you could have gotten a that's like a 6x, a 6x return if you had just put all your money into Apple at the height of the market in 2007. That is what I'm talking about when I talk about concentration. Yes, you can invest in ETFs, and yes, you can own 3,000 stocks and 5,000, you look at some people's portfolios and they just have like 10 different ETFs that overlap, and it's like you have way too many stocks in your portfolio. This is ridiculous. Part of that is people just don't know what they're doing. They don't want to take the time to research, and that's fine. If you're not going to take the time to research, then you probably should just buy ETFs. But what I teach you on this channel is how to buy and sell individual stocks. And what I'm doing is I'm trying to build my wealth, and I'm trying to help you learn how to build your wealth too. And so what that means is I'm showing you guys things like this. People don't realize that, you don't have to be in 100 different stocks. You really only need, maybe 5. But it comes down to you. Are you going to do the research? Are you going to have the risk tolerance? Because part of the problem with holding a concentrated portfolio is that it is going to be more volatile. So whereas an ETF might drop 5%, an individual stock might drop 10%. So you're going to have more on the downside, but you're going to have way more on the upside. I mean, Apple and Amazon up 2,000, up 5,000% since the low in 2008, and the total stock market is only up 360%. I mean, you'd just be losing thousands and thousands of dollars if you would have put your money into this ETF, this total stock market ETF, as opposed to putting it into Apple or Amazon or Microsoft or any of these other companies. We're at the high of a market right now. We're at a market top. Will it keep going up? I mean, I don't know. No one knows that. You can't guess the future. But what I'm saying is it's not risky right now even to only hold maybe 5 stocks. Here are my large cap dividend stocks. And you can see I only have 6 holdings. This is 10% of my portfolio right here. And the reason it's not more of my portfolio is because I am focusing on those smaller stocks, the smaller, the Shopifys, the stocks in the 10 billion to 50 billion range. That's where most of my money is going. That's because that's where I believe most of the growth potential is. But you can see here that these stocks have done really well over the past, I've only held this portfolio for like a year, but they've done extremely well. Up 81%, up 69%, 57%, 38%. So these stocks have done really well. And I'm really encouraging you guys, if you don't have a lot of money, if you are trying to grow your portfolio from a small value, maybe it's $100, $1,000, $5,000, go ahead and take on that extra risk and concentrate your portfolio. Try to keep it down to 5 to 10 stocks. For me, I have 54 stocks in this portfolio, but really, 50% of my money is going into one stock. One, build those portfolios, build wealth, build the financial future you've always wanted, and hit that like button, and I'll see you guys later. Thanks.